It's the evening of January 15th, 2026. The markets have finally closed. The noise is quieted down. But if you're watching the metals right now, you can feel it. That thick, heavy air right before a thunderstorm breaks. I'm a private commodities analyst. I've been stacking physical silver and actively trading these futures markets for 12 years. I built this channel, Veiled Wealth, because I got tired of waiting half a day for the mainstream financial media to report what I was already seeing in real time on my Bloomberg terminal at 3:00 a.m. And frankly, I got sick of watching AI avatar channels pump out fake news, recycled hype, and to the moon rocket emojis about silver with zero substance. So I use this avatar for one reason only: speed. It allows me to get you the raw data faster than anyone else without production delays. No fluff, no theatrics, just the signal. Tonight, I need to walk you through something happening right under the nose of the market. Something CNBC won't touch with a 10-foot pole because it exposes a mechanism they don't want retail investors to understand. Here's the hook. Silver got hammered this morning. At 9:45 a.m. Eastern, we saw a brutal vertical 4% dump. It was the kind of move specifically designed to trigger stop losses, shake out weak hands, and make retail traders panic sell their positions and swear off metals forever. The mainstream narrative? They are calling it a natural cooling period for a stretched sector. They want you to believe the silver bull is tired. But here's what they are not telling you. The screen is lying. Because while silver bled 4% at the open, the miners, the actual companies digging this metal out of the ground, barely flinched. The silver miners ETF, SIL, only opened down 1.4%. And by midday, it had recovered almost all of that loss. Let me say that again. Silver dropped 4%. The miners dropped 1.4%. That is not weakness. That is relative strength. That is the first signal of a major trend reversal. That is the smart money stepping in to defend a floor while everyone else panics. And here is why this matters right now, tonight. We are less than 12 hours away from Friday, January 16th. Monthly options. Expiration, OPEX. For those of you who've been in this game long enough, you know exactly what that means. It's the most dangerous day of the quarter for institutional short sellers. It's the day where billions of dollars in derivative positions either print money for the banks or explode in their faces. There is a reason the miners aren't moving yet. It's not because the companies are weak. It's because they are being held underwater by a very specific, very expensive anchor. Here is the thesis for this video. Silver miners are being artificially suppressed to protect massive bank short positions ahead of tomorrow's options expiration. That's the conflict. Silver spot is trading near $91. But mining equities are priced as if we were still in a $30 environment. This isn't just a lag. This is a structural anomaly that shouldn't exist under any rational pricing model. I'm going to prove this to you using basic math and a concept that most retail investors sleep on: operating leverage. Operating leverage is the magnifying glass of profitability. It's what happens when the price of the product you sell explodes, but your costs to produce it stay relatively fixed. Here's the simplest analogy. Imagine a lemonade stand. It costs you $1 in lemons and sugar to make a cup. You sell it for $1.10. Your profit is a thin dime. Now imagine a massive heat wave hits. Suddenly, people are desperate for lemonade. The price jumps to $10 a cup. But your costs? They are still roughly $1. Lemons didn't cost 10 times more overnight. So now your profit isn't a dime. It's $9. That is a 9,000% increase in profit from a 900% increase in price. That is exactly the situation with silver miners right now. And yet, look at the charts. The stock prices are flat, dead, pinned to the mat. That is the trap. That is the anomaly. And that is why I'm telling you here on Veiled Wealth that silver miners are likely the most undervalued sector in the entire global macro landscape. Now, before you think I'm just pumping hopium, let me address the skeptics. There are legitimate counter-arguments, and I want to dismantle them right now. Skeptic argument number 1, rising costs. Inflation is eating the profits. Diesel and labor are too expensive. My rebuttal. Yes, costs have risen, but they haven't tripled. If AISC went from $25 to $35, a 40% increase, but silver went from $30 to $90, a 200% increase, the margin expansion is mathematically undeniable. Go read the quarterly filings. Free cash flow is at record highs. Skeptic argument number 2, jurisdictional risk. Governments will steal the profits with windfall taxes. My rebuttal, this fear is exactly why the stocks are cheap. It's priced in. But skeptics forget that many top miners operate in Tier 1 jurisdictions like Canada, the US, and Australia. Even there, with higher taxes and wages, at $91 silver, the margins are obscene. We aren't looking for a safe 30-year hold. We are looking for the violent catch-up trade that happens before the bureaucrats can even draft the new tax laws. Skeptic argument, Number 3, the rigged game. The banks will never let the price rise. My rebuttal: I know the game is rigged. I've seen the spoofing. But even rigged games have limits. Even manipulated markets break when the physical reality overwhelms the paper derivative leverage. Tomorrow, January 16th, is when the paper market runs head first into that reality. So what happens next? Tomorrow is the third Friday. OPEX. There are massive open interest call positions at the $90 and $95 strikes. If silver holds above those levels into the close, institutional shorts are in serious pain. Expect dirty tricks. Expect volatility. Expect margin hikes or sudden technical difficulties on trading platforms if the price starts to run. They have a playbook, and they will use it. Here's my personal battle plan for navigating the next 24 hours. This is not financial advice. This is how a professional is trading this setup. Trigger number 1, the decoupling signal. I'm watching the silver to miners ratio. If silver price stays flat or red tomorrow, but the miners, SIL or SILJ ETFs, start going green, I'm aggressively adding to my positions. That is the clearest signal that the suppression is failing and the sector rotation has begun. Trigger number 2, the line in the sand, $91.50. I'm watching the $91.50 spot level on silver. If we hold that level through the 1 p.m. Eastern volatility window, I believe the floor is real and the path of least resistance is up. Trigger number 3, the do nothing option. If silver drops below $85 tomorrow during the OPEX chaos, I'm sitting on my hands. I will not catch a falling knife. OPEX days are designed to inflict maximum pain. Sometimes the most disciplined trade is no trade at all. I'll wait for Monday's clarity. Let's zoom out. In 2011, during the last great run, silver went parabolic first. The miners lagged for months, frustrating everyone. And then, seemingly out of nowhere, they exploded, with some juniors doing 1,000% moves in weeks. The miners always lag. But when the catch-up happens, it is violent, fast, and happens all at once. This is the media blackout phase of the cycle. This is when the smart money accumulates in silence while retail is distracted by AI stocks. So, to recap the veiled wealth thesis for January 16th, silver is at $91, but miners are priced for the past. This disconnect is being forced by massive options expiration tomorrow. The math of operating leverage makes this sector a coiled spring waiting to snap. The numbers don't lie, but the prices do. Tomorrow is the day the paper market meets physical reality. Tonight, review your positions. Check your stops. Be prepared for anything, including a final flush down before the rip higher. I'll be monitoring the tape in real time. If the dam breaks tomorrow, you'll hear from me. Stay disciplined. Don't let the noise distract you from the signal. The opportunity is staring you right in the face. Stay frosty.